Director, just firstly, your thoughts on the Atlas report today?
James, look, if we have a look at those numbers that have come through, it did look pretty strong. We've seen the company returning back to profitability. Those underlying earnings looked pretty strong, and of course we know that's a result of that record production and some tight cost control. But unfortunately, we are actually seeing that share price coming under a fair bit of pressure, down about 4%. And I do think that's a result of some of those numbers actually missing forecasts. So those underlying net profits coming through at $9 million, that was a significant turnaround from the loss the previous year, but that was actually about 4% below our forecast, so it did look like a miss on expectations. Their earnings more than doubled to about $248 million, but again, this was about 3% below our forecast, and it was at the lower end of their guidance range. And thirdly, looking at those revenues, again, pretty strong. They were up 58%, but again, that was slightly below forecast. So I do think as a result, we are seeing that share price coming under a fair bit of pressure. Of course, the surprise that we did see coming out of today was that dividend being declared, and that was actually double what we were forecasting. In terms of their outlook, it also looked pretty positive. They have reaffirmed guidance. They're targeting some savings coming into FY15 as well, and of course their capital investment spending is expected to be much lower as well. So that outlook doesn't look too bad, but as I said, coming under a fair bit of pressure, I think, missing those forecasts.
What do you think the outlook for this company is? Not that long ago, it was very much considered maybe a bit of a takeover target. Do you think that is still the case?
James, potentially could be a takeover target, given the fact that it is the highest all-in cost producer out of those iron ore miners, particularly looking at Fortescue and BCI, and it sits above those two. So I think we have sort of discussed this before, that those high-cost producers would be at risk of potential takeover. We are very cautious on the outlook for this one, given the fact that it is highly leveraged to any weakness in that iron ore price, and we know it is continuing to come under pressure. And of course, there are risks of those product discounts as well, and we don't expect them to sort of normalise until the end of 2014. Of course, looking at their Horizon 2 assets as well, we do remain a little bit cautious on those in terms of that port and rail solution that they still require. Horizon 1 is performing pretty well, but given the outlook, particularly for those iron ore prices and also some of their assets, we certainly do remain pretty cautious. It's trading at quite high earnings multiples at the moment as well, so given those risks, we certainly do remain very cautious.
Does that extend to the broader iron ore players? I mean, do you have a preference in the space?
James, we probably prefer one such as Fortescue, and given the fact that we are seeing these iron ore prices as continuing to come under pressure, I do think in the short term that is a concern, but I do think there is an expectation that we will start to see a bottom and we will start to see that iron ore price picking up again. So Fortescue does sit below Atlas Iron in terms of their cost, so at about $72. So it is still one of the higher cost producers in comparison to, say, BHP and Rio, which are obviously less risky, but we do certainly like Fortescue in terms of its underlying fundamentals, some of its cost cutting that they're expecting, and their lower net debt to come through as well. So looking at sort of those three higher cost producers, Fortescue would be our top pick in that space.
Just taking a look at Perpetual shares, seeing them down about 4.5%. This is, no, let's be honest, it's a bit of a serial underperformer, Perpetual.
It really is, James, unfortunately. Again, that result that came through looked pretty strong, but I do think it's missed some expectations and potentially a reason why we're seeing that share price coming under a bit of pressure. I certainly think we're seeing a bit of profit taking in the stock as well. It is up about 20% over the year, so it's had quite a good run. So I do think, given the fact that we've seen some of these numbers missing estimates and also looking at some of their outlook commentary, I think we're seeing a bit of profit taking in the stock. Those net profits were up 37%, but that was 7% below our forecast. Those reported net profits about 3% below our forecast, and also that final dividend was below our forecast as well. But looking at some of that key growth initiative that we know was implemented by the company in terms of the acquisition of the trust company, the integration of that does look to be on track, and they have actually increased their annual savings from $15 million to $18 to $20 million. So that looks quite positive. But overall, we do think there appears to be less leverage coming out of that business than we had initially anticipated, and probably a higher cost base as well than we were estimating. So that looks a little bit concerning in terms of that outlook. So we probably remain a bit of a hold on this one at this stage. As I said, trading at fairly high levels at the moment, in terms of that strong performance we've seen over the year. So we probably do remain a little bit cautious and actually do have a hold on the outlook for this one.
And just on the market, down about 0.5% at the moment.
James, it is. We are coming under a little bit of pressure today, although it does look like we are sort of trading sideways, given the fact that we've seen those overseas markets really stalling, and of course that iron ore price continuing to come under pressure. It's reached another 2-year low. So in terms of that materials space, we are seeing it one of the worst performers on the market today. We're seeing those iron ore miners as well as copper and those gold stocks are all coming under pressure. We're also seeing that property space, discretionary and energy. The only one really that's holding up our market today is that telecommunications sector. So it does look like those high yielding stocks are the ones that investors are sort of taking a bit of confidence in. So unfortunately having a bit of a negative performance today, but as I said, trading relatively sideways.
All right, Leah, thanks very much.
Thanks, James.